Good morning, everybody. It is Tuesday, April 22nd, and we are going to get started on our prep today for the ES and the NQ. First, just a quick reminder that derivatives trading is inherently risky and past performance is not indicative of future returns. So we'll start off again as we did yesterday, looking at overall volatility. And again, our high yield is still signaling credit risk in the market, which as we go into earnings season, the forecast and forward-looking statements are going to be critical. And if we continue to see this breakout again, that will put further stress on the market, not just for equities, but on banks and on their balance sheets. And then that is what we watch for in terms of a recessionary indicator. On to bond yields. So we talked about bond yields being more important and the bond auctions. We do have the 2 year today, which is going to be key, as that is what we watch for in terms of Fed policy, as traders look for short term for rates and put their bets on for rate cuts on the 2 year. And that's what we're going to be watching for. So we showed this yesterday, and we are coming down right to where we broke out on volatility, and we clearly couldn't come back in there. So we're looking for that continued breakout on bond volatility and fixed income space, as well as on the global currency markets. And this uncertainty is leading to these breakouts in volatility, which gives us a lot of opportunities to capitalize on, but also puts that stress on the equity indices for those trading. On to multi-asset volatility here. So we showed this yesterday that we have been trending, and yesterday we saw an uptick in overall asset volatility, multi-assets. The big difference was oil volatility. The OVX did not tick up as the market went down, so that was a good signal in the overnight for a long. And remember that it isn't about everything behaving the same, but what is changing each day and at specific moments in the day, and what are the outliers. And so oil was the clear sign overnight that once it closed its RTH session, when we didn't see volatility supporting that down move, we saw the bigger up move. Our systematics, again, are going to be on the sideline for the near future as they have almost completely liquidated their equity holdings. So until we see a shift in the market, this $500 billion strategy will not be providing any support anytime soon. Likely, we'll see this turn into more supportive flows in early to mid Q3, possibly some small bounces in positive flows coming in the next 2 to 3 weeks. But those would be short-lived, and really we look for around next earnings season, so in July, August, for the flows to begin to start being more supportive. Onto our correlations. We pay attention to these, and the biggest keys here are the breakdown in the correlation between the dollar and Bitcoin. Those had been moving in tandem. Now they are breaking as we're seeing the dollar break down and Bitcoin rising. And this shows us again the flow of assets out of US backed either securities, currencies, bonds, and into other assets. So we're seeing the 6J, the 6E with big breakouts. We're seeing the dollar begin to continue to break down, and we are seeing a stronger correlation starting almost getting to our triggering levels between equity indices and the dollar, which could provide further pressure onto the markets. So now for our levels for today, we can start here with the S&P. We are uh, inside of our rotational zone. We are below our line in the sand. Our biggest key today is going to be 5175 to 5183. That's our lower rotational band. That will have to hold for us to see upside. Below that, we will look for a stronger downside move. We do have Tesla earnings after the bell, so that's what the market is going to be watching for as the first report from any Mag 7 stock begins and what that guidance is looking like. And that will be at 410 to 415 today, right after the close. If we hold our lower rotational band, then we are looking for a move up through the pivot at 5250 up to 5300. That would be our rotational zone. And getting outside of that, we look for either 5366 on the upside or 5113 to 5084 on the downside. And then zooming in a little closer, You can see here we are just inside of our uh, inside of VWAP and just right underneath it at the moment. So again, we will look for holding that 51.75 to 83 and getting over VWAP. We will look for that 52.50, that Globex high, and then that will push us to that 5,300 if we get there. In terms of our volatility, we are we don't have any major catalysts this week, so we don't see that hedging coming in. We don't see that insurance buying coming in. And so we are just neutral right now. And again, for our subscribers, professional subscribers, you have access to these tools on the website, and we will be putting out some videos on how to use these. Now, on to the NASDAQ. The biggest level today is going to be 17,914 to 17,867. Again, holding that, we look for staying in our rotational zone up to 18,400 with our pivot at 18,124, just under the Globex high. If we break below that, we are looking for 17,657 and 17,508. We are over our minor line in the sand, which is around that 17,880, 17,900 area, and we are below our major line in the sand, which is up at our rotational high at 18,400. So those are the things we need to pay attention to as we go into uh, the day, into the bond auction at 1 o'clock, but really into Tesla earnings at the end of the day. Those are what we want to pay attention to and how much risk is in the market. And that's going to be the key to watching and then seeing if we get that downside or again, holding these key areas are going to push us back up and longs will be safer as long as we hold that lower rotational zone today. So I will post these charts in our room for you guys. The one last piece that we didn't hit on yesterday, and we did go over this, was the positioning from our commercials, but we didn't. I forgot to point out that our active funds are down to 35% invested, which we've only seen this model break down below this into recessions, into 2020, COVID, 2008. We saw these get down in the 20% area, 15 to 22. So this is beginning to tell us there's a lot of cash on the sidelines, but it doesn't mean that it's necessarily a buying opportunity yet. We want to pay attention to these, but we are getting trillions on the sidelines or at least outside of domestic equities. And so we want to watch this for the next couple of weeks for any signs of a bottom that is tradable, and that will likely come ahead of FOMC in the beginning of May as we look to see what Powell and the Fed is going to do with rates and if they're going to uh, do what the president wants and cut rates or if they are going to go on what they've stated they would, which is a slower approach and data dependent based on tariffs and no rate cuts. So we will watch the 2-year yield for that today, as well as this positioning in the coming weeks on how that's going to play out. So be sure to control your risk today, guys. Again, that is the only thing that we control in this. We can't control if the trade works or if we make money on a trade. We can control how much we're willing to risk to find out if a trade is going to work. So control your risk and have a great day, everybody. And we'll see you again on Thursday.